for this week's episode for our podcast, we're going to dig in a little bit more on the commercial real estate investing, like why people are investing, what people are seeing, and what and why it's the right time, right? So we always hear the adage, whether it's a stock market or commercial real estate to some degree, right, of most people like sit on the sidelines, they wait for interest rates to drop even more, even though it has no correlation to the Fed. They wait for more certainty. They wait for just the right timing to be able to time everything right? But the investors who look back 10 years from now, there's going to be a group that made generational wealth through commercial real estate. There's going to be like the group that looks back, right? It's kind of like the group today that looks back of what houses were 15 years ago when you could buy a single family house for 40 grand, right? And say you could have sold it for 200, right? So they're moving in 2026. And so today that's what we're going to talk about, more like the past and then what and why people should invest today and kind of what that means.
Yeah. And I think it's a great segue into it, Austin, because, people are always questioning, like, when's the right time to get into real estate?
Yeah.
And I think back to a couple of deals that we've done so far. And if you think about our SRI project specifically, right? We bought that project, I believe it was 2016, 2017, 2018?
Yeah.
So even better, right?
Yeah.
2018, that's what, 8 years ago.
Yep.
We bought that project for around $37 a square foot. Today, you could not put that project on the map for probably under 125 to 135 bucks a square foot.
At minimum.
At a minimum, right? And then the plant is built on top of it. That was actually a deal where we put in all of the capital to actually build the plant to our client specifications. And so I think we were all in around 50 with all of those improvements, but still you're 3 times that amount, right? So when you look at the value of that property, yes, it might not have a lease on it, or there might be some other intrinsic things that cause it to not have a massive number as far as what the value is on paper, but the value to a client or to a user is massive, right? Because you're not going to build that thing. And it's interesting because as I was watching the news this weekend, I was watching some documentaries about wages and where wages in the trades are going, right? And wages in the trades today, this young person was talking about the fact that he made about $235,000 this year working on data centers as an electrician. Mm-hmm. So if you think about that, and he was super proud of it and should be proud of it, right? The trades are definitely a place where young people can make money. But if he's getting paid $235,000, what's the cost to construct that whole data center or that building, right?
It's massive, yeah.
So it's not getting cheaper to produce that building. So there again in lies the concept of, why invest today? Why did we invest back then? And what is the opportunity for that value?
Well, I mean, you look at your portfolio, right? You invested through downturns, you invested through up, and now we're still investing in downturns, right? So it's always interesting to me because like with a group like us, we're a cash flow group, so we're long term normally, right? If you invest for a long term return for a project, you're going to do well. Because like, when's the last time you heard somebody say they regretted buying real estate in a downturn if their plan was to make money over 15 to 20 years?
Exactly.
You don't hear it, right? And
our portfolio today, just as a litmus test, puts off about 12% cash on cash, including all of the raw land, right? So if you took out the raw land, you're probably at a 15 to 18% cash on cash return. But the concept that I think we've implemented over the years is really dollar cost averaging, right? So if you think about your 401k, think about everything you put away for your with your retirement funds, everything like that. All of your investor relations people would say dollar cost average. Put in $1 today, put in $1 next month, put in another $1 the month after, and over time you're going to kind of ride that high and low dip. Real estate investing is no different. You're going to have if you're going to time the market perfectly, you're probably going to miss it.
And it's kind of like not to step in on you, but it's kind of like you look at the 2020 era, right? The COVID era, right? So today's investing is different than it was 5 years ago, even, right? So
Absolutely.
5 years ago, you could go buy a retail building or any building for a cap rate that you could have cap rate compression, right? To where like you could buy it at a 9 cap, and in a couple of years, there's a good chance it's worth a 7, just because of how crazy the market was. There was that time period where you could do that, buy it for this, sell it for this, not do anything to the thing, and like it's fine. But today, everything's more income, right? It's more about how are you underwriting an asset for the long term. So it's more about a cash or cash on cash returns that are income driven, not cap rate driven. Because if you play the cap rate game, I think you fail today because there's so many people trying to get in.
Yeah. And I believe that I've seen a lot of the compression of pricing though. Like, you know, everybody's like, oh, commercial real estate's dead. There's no more value in it. I believe that it's been repriced already, and it's going to start to climb back out again as with higher prices in value. Would you agree?
I think for maybe for higher value potentially, but I think people are underwriting so like just more strict.
That's a good point.
I don't know. I think everything's got to be driven based upon income over long term. Otherwise, it doesn't work, right? Because pricing may increase, but what is it going to increase to? Like back to where we were in the COVID era, where interest rates were at 4%, 3%, right? That's not going to change anything, which means I don't think that the price is going to increase dramatically unless it's driven by income, right?
Yep.
So if the building is renovated correctly, upgraded correctly, and the income is there, or the value add is there, like getting rid of the common area, adding more rentable square footage, whatever it is for it, making for it so it's like taken from an old crappy industrial building, let's call it, that is now like moves into like small bay. Like I think that's where you can see a lot of value of taking that old asset and like making it something new for today's day and age. But just buying an office building and then, or any type of building and operating a thing, like the price will increase. I don't know if that's going to happen.
No, I would agree. But I think there's, to your point, there's a lot of stuff that we're seeing in market. The value add is definitely there. You know, increasing that common or decreasing that common area space, but really putting the amenities to it. So it is top of class when you look at, you know, in that market sector, how many other buildings are competing with you for that Class A office. You know?
But I mean, to your point, like it could still, like the values could increase just because of international money's been kind of leaving the country, and at some point it's going to come back. And that's probably more of the driver, but that's probably coastal drivers, right? It's probably the Californias to Arizonas to Floridas to East Coast. It's probably all coastal driven.
Let's go back to the underwriting for a second, because it's interesting to think about 5-10 years ago, how we underwrote things and how we underwrite things today. Put that into perspective of maybe how even a retailer today would look at, you know, like we used to talk about Starbucks and Caribou's and stuff, and they needed the X, right? So if we look at the X of what we want today, very strategically or specifically, what are some things that we would underwrite to today that we wouldn't have maybe noticed or put up stop signs to not go after an asset 4 or 5 years ago?
I think for us, like today, like, and it's some of the stuff that I'm actually working on now to upgrade and look at our investment thesis, if you want to call it.
Yep.
I think today you have to, besides like the typical non-traditional, I mean the traditional mechanical systems, tenants, like it's all the same, right?
Yep.
It doesn't really matter.
It's got to run.
It's more about now, like, what is your true thesis from an investment strategy for your investors and for us, right? And to me, that leans itself into where we've kind of transitioned some of our portfolio. What we've talked about is that more last mile industrial, small bay industrial, right? That is service-based users that they need real estate, right, to some degree, or it's retail with service or grocer, right? So again, it's a retail center in an area that serves a community, or it's a grocery store that serves a community that's not leaving. And then I don't think it's really office anymore unless it's med.
Yep.
So I think the last piece of that is all medical, because medical is not going to go away, right? And it's the thing that I look at it is it's global, right? So everything is changing, and you got to stay on top of it because AI is here, right? It's pretty tough to go, I'm not going to go buy a Target building or an Amazon building or a Facebook building when they're laying off 20% of their workforce because of AI, right? So you got to go against AI-proof businesses. or areas that the buildings will always be there or operate within.
And I think what you were saying earlier is really key. I mean, the competition, I mean, the amount of market that's on, or amount of capital that's on the sidelines in market is probably larger than ever.
Oh, totally.
For probably half the assets that we, if more assets. So then it is really strategically, how do we create partnerships with, users that might want to also be a partner in the building? Really becomes that medical, that that strategic manufacturing, small bay potentially, maybe some office, but it's going to be very strategic because we're going to underwrite. Where I was going with this, we're going to be underwriting that business a lot heavier than we were. We're going to be looking pretty deep into that business, where before we kind of said, hey, business ABC, they've been going for 10 years, they're fine. We won't worry about them because they'll be around for another 10 years.
Correct.
Fast forward to today, we look at that, law firm or that CPA firm or some of those other firms, and you're like, they could be gone in a couple years. I mean, and probably will be gone in a couple years.
I mean, look at where AI is at, right? What kind of businesses does it hit?
So moving our thesis and that underwriting to really understand the business model of what's coming in as a tenant or a partner in the business, right, in the building, is probably more important than ever now.
Yeah, right? It's kind of like, like a good question for it even is, when you look at a deal, like let's say it's a med office building, because we're actually looking at one right now. Would we rather have that deal where let's say there's 7 people looking at that deal and potentially putting offers on, but it's a med building in the right community that's probably going to be there in 40 years, that is probably none of the tenants probably going to leave. So your cap rate's going to be suppressed, right? So you're going to pay more. Or would you rather go buy the office building or something that's distressed, that there's 2 bidders on, that we're getting a deal on, right? What would you really look at today?
It is 100% what's going to be around, right? And I think about and apply the same thing to I don't remember the tower that Target was in that they just paid off down in Minneapolis.
Oh yeah, they paid off the lease,
right? So they paid off the lease, but they paid off the debt in essence, right? It was a $110 million lease payment, and I think their debt was real close to that.
I'm sure it was exact.
So fantastic, Austin, right? We have this 30-story tower. It's paid off, right? And we are sitting in glory land, or are we, right? What do you think it costs to run that building on a yearly basis? Probably $5 million.
Probably at least.
At least.
Call it $10 a square foot.
So you're upside down $5 million a year on operating costs, right? And what do you think you have to put into that building to reposition it, either for multifamily or amenity packages? I mean, you're dumping another $10 to $15 million into that building.
Minimum, you're $100 a square foot on office build outs,
right? And while the building has a value of X to build it, the building on market in downtown Minneapolis probably has a value of maybe $10 million.
Correct.
So you're upside down $10 million against value, right? Not cost to appraised value, cost to actual market value.
And that's what the difference is today, right? It's so weird because you even think 5 years ago, right? It's the weird analogy. 5 years ago, but people got into real estate, right? Or put their 401ks or IRAs in with big funds that invested into big buildings, right? Whatever. Because it's brick and mortar. Like, brick and mortar is never going to go away. Like, you own the bricks, right? Well, yes, you do. But today, it's not that same analogy, in my opinion, right? There's so much more that goes into a real estate deal to be able to make it work. Not today, but 15 years from now. Like, you have to try to look at your crystal ball and be like, what's going to happen in 15 years? And how is it going to affect the real estate that I own? Because you're probably not going to see a cap rate suppression. Like, you have to look at it as income. How can I make the most income on a monthly, yearly basis over 15 years?
And I think that's what's interesting when we talk to our investor partners that we're building buildings or developing buildings with, right? Because that's one of the very unique opportunities that working with a company like ours, where they can bring in X amount of cash today, right? So let's just say they're 25-75, right? They're 25% partners. But in a lot of our leases, we're very flexible to say, you want to buy us out, you want to buy more, become a different level of partner, they can do that, right? So they ultimately can create some more capital, or cash flow for themselves, but we've got a built-in partner that's going to be in the building. And so they're I mean, and obviously markets change, things
Yeah.
change, but they're in it for the long haul, right? And so it makes it a little bit more opportunistic for both parties to think about how do we leverage that for the future, right? So maybe they don't own their whole building and they take the risk of that whole building, but maybe they'll go invest with us in another property as well. So I think it's a unique opportunity for somebody to look at cash flow. They get some rent back over the course of a month that probably won't offset all of their rent that they're paying, but there's some income that they can make from that as well. So,
Correct.
and they're doing it in commercial real estate, which again diversifies their own portfolio.
Totally, and that's the big thing is how do you diversify from an investor standpoint? How do you grow? But how do you grow into businesses that are growing, not dying?
Yep.
Right, and that's the hard part today.
I want to take a quick dive into, you talked about AI and I had mentioned data centers. Just for everybody listening, what's our take on data centers? What's our crystal ball for the future of data centers? Because it's the rage of everybody investing right now, and I have my opinions, but I'd like to hear yours.
I think, to me, data centers are needed. They're extremely crucial for AI and for us to get to where we're going at this point, right? Regardless of what people think about it or don't think about it, like, we're going there. I don't care if a city doesn't want a data center, does, like, that's where it's going.
Yep.
So you can either take it or you can say no and somebody else will build it. But from an investing standpoint, the dollars are just too big.
They're
right?
massive,
They're crazy. I was talking to my brother-in-law. I was looking at doing concrete for one of them, and they just pulled out because they're like, we're not dealing with it. We're like, it's too much risk. They don't know the timing. The general contractors don't know what's going on because it's a general contractor of a general contractor of a general contractor. So many layers, and nobody knows timing or anything else. So how are you supposed to plan?
Because they're just trying to plow these things in.
They're trying to plow it in, and what happens when you move too fast?
Yeah. You fail.
Yep. Something goes wrong. If one thing goes wrong in a data center, the whole thing's dead. And what? So then all of a sudden $200 million is gone. And what happens in 10 years when the new technology is out and we don't need it anymore?
I look at it, and it's kind of funny you said that, because I think of this, through 2008, I watched the Bakken oil fields light on fire, right?
Example.
And everybody rushed to the money. Excuse me. And everybody plowed out there and went, we're investing, we're diving deep. And for the first 3 or 4 years, it was gold rush, right? It was great. It was manna from heaven. And then all of a sudden you started to see the chink in the armor. And the people that got in the last, right, definitely felt the pain of, the reversal of the need. And I think you're going to see a huge rush of 1,000, 2,000 data centers being built across the United States for 2 to 3 years. And then it's done. I mean, to your point, there's going to be something else. We're going to be quantum computing. We're going to be computing in.
They're going to do the same thing in a tiny microscopic way, because there's going to be a new version of energy that allows a data center to run more efficiency in a smaller scale.
Yeah, and the use of water. I mean, obviously, it's a big issue, across the country and the globe, for that matter. And people are already working on that solution. So you think about it, it's like we created the Sony Walkman. And what was it, 7 years? I think the Walkman was already obsolete. Yeah. There's an end game for these data centers. But what they get used for, who knows? But I wouldn't, as an investor, as an investment thesis, right? To your point, it's just so massive. The only way to do it, and it's kind of like we talk about cannabis, you got to exit early. Like, build it, exit as fast as you can. Take whatever cash you can make on this from a return and go do something else with it.
Yeah, I totally agree. And a lot of them are kind of, you don't know what you're going to make on them because what's the revenue coming? They're leased, right? Well, how long is the lease? And again, after the lease, is there going to be a data center that backfills it, or is that lease going to be with Facebook, and then in 10 years, or say it's a 20-year lease, great, you made 2 to 3% money for 20 years, and now Amazon or Facebook's figured out how it works, and they're just going to go build it themselves. Like, that's what's going to happen. Like, these are being built to be global, right? But at some point, the big companies that are actually using them, the Googles, the Facebooks, Amazons, they're all just going to build their own once the pricing comes down and they're reasonable and they actually understand how they operate. Why wouldn't they have the big data center within their own building? It just makes sense.
Yep. Other things that you think are moving our market today that didn't happen 5 years ago? Is there anything else that we can think of that our viewers would find interesting to hear us discuss about?
To me, I see a lot of people like interested in real estate, and it's probably more like the 5 years ago. I'm gonna go like a little pre-COVID even.
Sure.
The amount of people doing syndications that don't have the history, right? Everyone is getting into it. Everyone is saying that, oh, I'm doing this real estate deal or this or that, right? And we know a few of them in St. Cloud even.
Yep.
And that's always the buyer's beware, in my opinion, for anybody trying to invest. And it can be a business, it can be anything, right?
Matter, yep.
What is that person's track record? What have they done, right? It'd be pretty hard for us to ask for money from other people if our portfolio wasn't over $190 million.
Yeah.
It'd be almost impossible.
And I think and it's a great point, is that, we hear these syndicators, and everybody wants to be a syndicator. They also want to just, be a flipper, take a deal, get it in, paper it, and then all of a sudden, well, I'm going to roll it over to somebody else who actually owns these things sometimes, right?
Yeah.
And we even see title issues over time to time, but doing it the right way. I mean, I look at this Walgreens deal that we're putting together. For the investors, we are protecting them. These deals, when we take them over from survey to title to mortgage, when that asset is purchased in our portfolio, the investors are protected from the things that can go bump in the night for these things. Now, you can still have, tenant issues. You can still have, building issues for some crazy thing. But all of the things that we can at least see and protect for, we're doing. And when you see these guys running with 3 or 4 assets and they're just kind of cobbling stuff together, buyer beware. I think it's a great
yeah,
point.
I even look at like there's brokers. Obviously, like the name for a broker is for them to build a career in brokerage, right, and then to start syndicating, right? Because that's that next step, right? Yep. You make $1 million a year as a high-end broker. What's your next step from an income standpoint or a growth standpoint? Is it not be doing brokerage, just to get into ownership, right? Which is, from an investment theory, is perfect because those guys know the game the best when it comes to how the investment works.
Yeah.
Tenants, underwriting, that kind of stuff they have down. But it's the other side of it they haven't dealt with yet, right? They haven't done the title work. They haven't done the surveying. Yeah, maybe they've helped. They've done due diligence to some degree, but not understood the numbers to the level that we do. So it's still that same thing. If they have the history on one side that is superior, by all means, the tenants, where the money's at, how much it is, who the players are, who's probably going to buy it in the end because I know the users and everything else. But then it's, how is that due diligence package running? How are you reviewing loan docs? How are you doing the title work? How are you doing the surveys? What kind of owner's policies are you getting on your freaking title? Mm-hmm. It's all of that kind of stuff that is not sexy, but it's a pain in the butt when it comes up and when it happens. And if you don't take care of it on the front end, when that seller is engaged, you're never going to get taken care of.
And I think the real point here is that we're protecting our investors from the problems.
Correct.
Right? We're protecting them from the things that they don't understand or know, or technically should know, right? I mean, as an investment portfolio, our job is to really, we help them create the value, we help them create the cash flows, and we manage it for them. So when that check comes through on ACH through our platform, they're just taking the check and going to spend the money, and we're taking care of all the heavy lifting behind the scenes.
Yep.
Property management, property maintenance, all of the asset kind of stuff, K1s, I mean, all of these things that are happening on a weekly, monthly, yearly basis, we're managing for those investors. Mm-hmm. Mm-hmm. And then thinking about disposition at some point, right? Maybe there's a time frame where the value of the depreciation is waning down, right? Maybe we took bonus depreciation in the front end. Now it's 5-6 years later. You and the asset management team will sit back and go, you know what? I think we should ... Mm-hmm. And that might be a repositioning, might be a disposition, 1031 trade, whatever the things are. That's our role as the investment portfolio managers.
Yeah, right? No, exactly. I even think of like investors, and we have a lot of it too, like where people want their K1s by a certain date, right? So they can get to their accountant. And we hear that a lot this time of year, especially, mm-hmm. which totally makes sense and I can understand, right? But it's all about what the investors don't see on the backside, right? Is maybe there's a reason why that is that we got the return back, or we're doing a cost seg that takes more time so they get better depreciation, or we're reviewing stuff when it comes back, and our accounting team and us are reviewing it, and we're like, okay, we're missing X, Y, Z. We got to go back.
Yep.
And the CPA team has to re-review it, readjust it, right? So maybe that's a better situation, or it is something that ends up being caught, so there's no discrepancies, so we don't get audited, and there's something dealing with the IRS in the future, right? Which, if you're a one-man band, you can't do. You don't have a team, and you can't trust a property management team is never going to catch it because it's not their responsibility.
And it's funny because we probably review 5 or 6 tax returns probably a day right now, it seems like. And even through the whole team, and you and I sit down, all of a sudden there's like, nope, there's a glitch here. We saw something. It's like, okay, that wasn't the way it was planned on running. And so even through all of our layers, right, which our team does a great job of getting to that point, we're still catching final things, which then we push back up to our CPAs, maybe to our team. It takes a couple days, a week to remedy the situation. But all of it, because we're aligned in the platform with our investors, we're thinking about it, how does it affect the asset, right? And so ultimately that's going to affect the investor and the investor return and what the taxes look like. So yeah, sometimes taxes aren't always on time, but there's a really good reason for that, right? Is that
there's
we're trying
something going on.
We're trying to make the best for everybody, and bring that return in.
No, I would totally agree. It's one of those things we kind of look at the end. Like, so when it gets, say we're in 2029. I know we won't, but like when this cycle, as I'm going to call it, is fully written and dialed in from, call it, what are we, 26 to 29, will we be the person who bought at the bottom, or will we watch someone else do it, right? It's kind of the same thing for all the viewers is, are you going to watch on the sidelines while people are investing now, waiting for the perfect time, or are you just going to invest your way through it? Because you're never going to nail the downturn perfectly.
And I think about if you buy right, if you buy right, you're always going to make money in real estate.
Yep.
You always make money on the buy side. And I think that's a part of our underpinnings of our thesis has always been that, right? We're not like a REIT who overpays for stuff and then, 2 years later you see them hemorrhaging and they dispose of
we're done
$200 million of assets. We're buying it on the right side, so our underwriting is going to always allow us to be on that, hopefully more positive side of that.
Because we're looking at it over a long-term horizon, not a 3-year window with the sale.
And I think that the point that Austin's making, and it's a really good one, is, have you ever sat and said, oh, I should have invested in that. I should have invested. If that's what you're saying, then you need to start pivoting your mindset to saying, no, I'm going to invest.
What should I look at? It's a rearview mirror, right?
Yep.
Oh, I should invest in that. It's like, take that rearview mirror off and throw it in the garbage, right?
Yep.
And it's something you say a couple times.
100%. Well, it's a good talk, man.
Yeah, no, this is good. So it's kind of ending with more like, if you're an accredited investor, so we only work with accredited investors here at Inventure Capital, and you want to understand opportunities, how Inventure is seeing things in the market right now, reach out to us directly. You can obviously subscribe on our podcast, YouTube, follow us on LinkedIn, Facebook, Instagram, send us a DM, whatever it is. Send us an email at invest@inventureproperties.com, and we're more than happy to sit down and kind of talk through anything that anyone sees. But thank you, everyone, for following on this one. Until next week, everyone have a great week.
Appreciate it.